Okay, so we're going live with IBEX. I'm going to give it a couple seconds for the audience to populate before we kick it off. Okay, so welcome to the Sidoti Virtual Conference, and thank you for joining us today. I'm Anja Soderstrom, an equity analyst here at Sidoti. And as I mentioned, we have IBEX with us. We have the management team. We have Bob Decant, the CEO, and Taylor Greenwald, the CFO. This is going to be conducted as a presentation, and that will be followed by Q&A, and you may participate by submitting your question at the bottom of your screen. And with that, I'll hand it over to you guys. Thank you for joining us today.
Thanks, thank you very much. And Taylor and I are really excited to be here today and appreciate your time and interest in IBEX. We have a great narrative, I think, to tell you, and we're excited to tell this narrative. So let me give you all a little bit of a background of IBEX, what we do. So, we help connect some of the world's best brands with their customers seamlessly with human agents and AI agents. And so if you think of us as consumers, when you need a question around a e-commerce platform, a package you're waiting for deliver, I'm a member of a healthcare provider and I have questions on my benefits, things like that. We have a whole bunch of agents, about 38,000 employees around the world that focus on delivering great experiences to us as consumers and members and things like that. And we do that across a lot of different geographies. What we have and really excited is a business that continues to build great momentum and separate ourselves from the pack, as I like to call it, separate ourselves from where our competitors are. We're not the largest player in the industry by far, but we feel like we have the best resume of anybody. We finished our calendar year at a very strong growth of 16%, EBITDA at 16%, adjusted EBITDA 44% increase year over year, and a strong free cash flow year. So we're kind of hitting on all cylinders financially, and we've been doing this, and Taylor will cover this in a little bit, but we've been doing this for many years, and it's a long track record of continued up and to the right, and the momentum continues to build. Give you a little background of the industry with which we play in. And so, we kind of look and say we are in the contact center space. And that's about a $350 billion market between clients that outsource and clients that run their own internal centers and clients that do both. And most of the clients that we have kind of do both. So about 30% of that, or about $100 billion, is in this outsourced area, which is, kind of the segment that we play in the BPO space. And of that $100 billion, it's a highly fragmented industry where there is no massive dominant player that has, 60% market share. The largest 10 players, which kind of range between $10 to $11 billion in revenue to about $2 billion in revenue, they only represent about 35% of the market. So this space has a lot of opportunity for disruptors in this space, and that's kind of what we've done. And so in this world, we look and why we think this is a great space. There's a whole lot of TAM to go after, and we believe as costs, and kind of challenges, clients are going to continue to look to outsource more and more over the next 10 years. I would like to take a minute to talk a little bit about this industry and kind of what we've done in the unique position that we have in this industry, which we call BPO 2.0, where we think we've built ourselves into the leader in this world. But to understand that, I think I'd like to talk a little bit about the journey of this industry. And with that, I'll start with, kind of how this industry operated in the first 20 years. And I've been in this industry 25 plus years. So, from the mid 90s through about 2010, 11, 12, in that range, this industry was what I call BPO 1.0. It was large labor arbitrage play. Bigger was better. The competitors in this space did many acquisitions to become bigger and bigger and bigger, not necessarily better. And, cost was the prime focus of the outsourcing game. And so these businesses were built solely for that. And they won a lot of market share along the way. What happened though, along the journey is in all verticals, clients started, there were disruptors in all verticals. And, whether you think of things like Amazon and the e-commerce and, kind of retail space, and if you think about Netflix, and then all the way even to companies like Lyft and Uber, all of a sudden, there are these disruptors to traditional business models. And one common characteristic is the customer experience, the customer loyalty was key in that. And so as it related to how they interacted with their customers and members around interactions, they looked and said, this needs to be an extension of our brand. And so decisions started being made on who can be the best extension of our great brand. And all of a sudden, it wasn't a cost labor arbitrage driven business, but it became a business of who could differentiate, who could raise the bar, who could deliver great experiences. And this created an enormous opportunity for disruptors like IBEX to come in and go into this space where the other guys were not geared towards and win big. And that's what we've done. And so kind of a common characteristic, if you fast forward to today, is the companies that still live in yesterday are negative growth, they're flat growth, they're really struggling, declining margins, highly leveraged balance sheets from M&A. On the other hand, when you look at, companies in this BPO 2.0, we're growing higher, common characteristics is high growth, double-digit growth, expanding margins, and a strong balance sheet. And we think we built ourselves into the best disruptor. And how we've done that is really putting this, what we call this, BPO 2.0 power stack together. And it takes our culture, it takes a really powerful tech stack, which we call Wave IX, and then a business insights organization that provides amazing insights for our clients around customer dissatisfaction and points of friction. So we create this total solution that's geared around creating great experiences, enhancing loyalty with their customer base. Now, those things are easy to say, but the proof points that I like to highlight on this is culture, okay? It's easy to say we have great culture. Well, we measure this. Our employee net promoter is 77. That's world-class. That's significantly better than any of our competitors, where I would render a guess that they would be at a 20 or lower. What this means is our agents care about this. They show up, they stay with us, and they're passionate about their job. And so if they're engaged with great brands, they're going to deliver a great experience. So if you take this great agent that has, enormous loyalty, outfit them with technology and deep analytics, we've created a differentiated value proposition that labor arbitrage guys don't have, where they're just throwing bodies at things. And at the end of the day, this all works out well, and we measure this. So our clients value this, and they see you are a trusted partner. And they have our client net promoter is 71, which we think is world-class, significantly better than anybody else. And so we don't lose clients. And so we have about a 98.5% revenue retention amongst our clients. Clients don't leave us. And so we've created this flywheel where we have this differentiated offer that allows us to go win trophy clients. We win, they have a large spend. We grow, we expand with them into new geographies, new lines of business. They don't leave us, and it just creates this flywheel for growth. So new logos, grow them, land and expand them, and they don't leave us. And we take market share from the big guys. That's the business that we've built. Now, what we think we are the best in is where this industry is going, which I call we are defining BPO 3.0. And this is where we layer in AI on top of what we are doing. AI to help us transform the operations, and AI where we complement our human agents with AI agents. And so we're providing this end-to-end solution. We think that positions us well going forward as this industry is going. And so we've done this on the big stage. We've done this in what I call trophy clients time and time and time again, where we win these clients with their differentiated value proposition. We land and expand, we grow. And so we've created a roster of clients that all have large amounts of spend, and we're taking market share away from our competitors to fuel our growth. I'll give you an example of one of these. If you look at kind of towards the center, the number one healthcare payer in the world had a roster of multi-billion-dollar players that they had been servicing them for 10, 15 years. It had been 6 years since they brought in a new challenger to that. It took us about 3 years to sell into there, but we finally got into there. And within 90 days, we were outperforming the status quo significantly. So much so that they launched us within 90 days into a second site and more lines of business and continued to grow. Well, we're now 4 years into that journey. In the first 3 years, we were their Innovative of the Year in year one, Partner of the Year in year two, Partner of the Year in year three. No provider has ever won back to back. So we're consistently outperforming kind of their status quo legacy, much larger partners. And so fueling significant growth to our business and to our healthcare vertical. And I can tell that story time and time again. And so we've created this competitive moat that allows us to win these new logos, take market share from our competitors, land and expand. We don't lose them. And that's created what I think is a long-term, many-year trajectory up and to the right. So with that, I'm going to pass it over to Taylor. We think we have a great investment thesis that pulls all of those things together. And so with that, Taylor, over to you.
Thanks, Bob. And as Bob mentioned, we have a very strong financial profile. And it's not just a one-hit wonder, right? We have a long track record of growth in all our key financial metrics. And on the slide in front of us, we have some of these metrics and kind of the growth over time we've seen. If we start in the graph in the upper left-hand corner, it shows revenue. And this is our organic revenue growth. We have not, all our growth over recent history has been organic and not through M&A. And you can see our 4-year compound annual growth rate on the revenue side is 6%. You'll also see that there was a little pause in growth between fiscal year 23 and 24. This was sort of the time period when AI first started being discussed and made an introduction into the market, and people were kind of holding off on their purchasing decisions. But if you look past that year, our average growth has probably been closer to 10%. And as Bob mentioned in one of his slides, if you look at calendar year 25, it's 16%. So our growth has been building and continues to have great momentum. Moving over to the graph in the upper right-hand corner where we have adjusted EBITDA, you'll see that EBITDA growth has been almost twice our revenue growth. So we're getting good leverage on the P&L, which is what we want to see. And what's really driving that is the vectors of growth are high margin services. So we're seeing the vertical markets that carry higher margins driving our growth. And we're also seeing our geographies, higher margin geographies, the geographies where we're seeing growth. So that's certainly a very good characteristic of the business. And then moving ahead to the bottom left-hand graph, this is where we have our adjusted EPS, and we're seeing even more leverage, right? So 6% revenue growth, 11% EBITDA growth, and then on EPS, 19% EPS growth. And key factors there, obviously the strong operating performance that's showing up on EBITDA is driving our EPS growth. But we've also been active in share repurchase, and we have repurchased about 30% of our shares over the past 2 to 3 years. So been aggressive with share repurchase as well. And then finally, moving to the bottom right-hand side where we have free cash flow. Free cash flow is strong, it's predictable, and it's growing. So it's a very nice characteristic of the business that we have good visibility into cash flow. Moving ahead to our more recent results, just to take a snapshot of our more recent results. Here are our Q2 results. And for us, our fiscal year ends on June 30th. So our second quarter is the quarter which ended December 31st. And here, if you look on the right-hand side, you can see we had 17% revenue growth, 32% net income growth, and 45% EPS growth. So these are GAAP results. And once again, similar to the longer term trends, even in the short term for Q2, you're seeing nice leverage throughout the income statement. So that's great to see. And what's really driving the results, as I mentioned earlier, the vectors of growth are high margin vertical markets and offshore geographies. You can see where our health tech vertical grew 35%, travel transportation 20%, and retail 17%. So those high margin vertical markets are driving our growth. And then we're also doing a really good job managing our SG&A expenses to make sure they're they're growing more slowly than our revenue growth. So SG&A expenses year over year went from 18.3% down to 16.8% of revenue, so 150 basis point improvement, which is another good leverage for our business. We have a nice platform that we're able to layer revenue on and scale the business. Moving ahead to our non-GAAP results, very similar to our GAAP results. We don't make many non-GAAP adjustments. The big ones are stock comp and then also foreign currency gains and losses. But you can see EBITDA grew 25%, adjusted net income grew 33%, and adjusted EPS grew 46%. So very similar to our GAAP results. And our EBITDA margins, we've done a good job year over year driving those 80 basis points from 11.8% to 12.6%. And once again, it's the growth where we're getting the growth and also managing our SG&A expenses is what's allowing us to continue to expand our margins. Moving ahead, and Bob touched on this. He had a slide where he showed kind of some of our top clients, and on that slide it said that we had 60 clients, $1 million or more in revenue. So we have great diversity among our clients, which is unique for BPOs. We probably have greater diversity than most BPOs. And then not only do we have great diversity among our clients, but we also have great diversity among our vertical markets. And you can see here we have our vertical markets, and they're all probably between 10 and 25% roughly of our overall revenue. And they're all growing nicely outside of telecommunications, and that's intentional. That vertical tends to have lower margins, and so we're not putting resources against it. We put our resources against the higher margin verticals. And as I mentioned when I was discussing our long-term revenue trends, this is all organic growth, right? We're not doing acquisitions to hit certain revenue targets. We're growing organically. And a good example is the healthcare vertical, where 4 years ago we had zero revenue, and now exiting this year we're going to have close to 100 million of revenue, all organically grown. And we have leading healthcare providers and payers. And it's a nice vertical that's higher margin and one that we still are bullish on. I think we can continue to grow. But that's just an example of kind of our land and expand and our ability to grow our business organically. And then finally, wrapping up, it's important for us to maintain a strong balance sheet. And if you see, we have virtually no debt. Our cash balance is roughly $15 million. And recently in the first half of this year, we've had record operating cash flow both in Q1 and Q2. So we're keeping up this trend, and we're using that cash flow right to reinvest in the business. We expand our capacity, but we build our capacity to meet demand, not ahead of demand. And a lot of times we build a new facility, we're getting a payback in as little as a year. So that's a good area we're investing in. We also continue to be active in share repurchased about 200,000 shares in the first half of this year. So we're proud of the fact that we maintain a strong balance sheet, and we feel like this positions us very well to enable us for future growth in terms of adding capacity, adding sales resources, technology solutions, all the above. So we feel like we're very well positioned to continue our growth with our strong balance sheet. And with that, I will just want to thank everybody for joining the call, and we're open up to questions.
Thank you so much, Bob and Taylor. And for the audience, if you have a question, you can submit it in the Q&A function at the bottom of your screen. So I'll just kick it off here while we wait for the questions to populate. What kind of visibility do you have on the revenue, and how sticky is the business with your customers?
Yeah, Anya, thank you, and really, really good question, and appreciate that. Look, we have start with the second part of that, the stickiness. Our stickiness is we have enormous stickiness on this. First of all, it's driven by great performance, and doing a better job than kind of the other competitors that we're competing against on each client. That drives the day. And if you look at the metric that I shared of our kind of our revenue retention, we have less than 1.5% revenue exiting the business. So I think that is enormous stickiness in this space. Most of our competitors are kind of in that 10% going out the back door. So we have strong stickiness driven by performance, the tech stack, and the insights that we're providing for our clients. Now, the question to visibility is kind of one of those. It's a really good question. Most of our clients have, it starts with the client's visibility. And so I would say most of our clients have good visibility about 2 to 3 quarters out. They project 12 months out, most of those, but their visibility to their business is, kind of out in that, quarter 4 and latter part of quarter 3 is less accurate. So we feel we have good visibility. And to that point, we've guided this business. We've been on a beat and raise for quite a few quarters in a row, as we did in our most recent quarter. And so, we feel very confident in where we're going to finish for our fiscal year, which will end in June. And, we kind of feel like there's strong growth, in that. And then, we are now starting the planning process for FY27. And, look, we feel like kind of what we've built here, that's representative of where the trajectory of this business is.
Okay, thank you. And you also had a pretty impressive employee retention and score. What do you attribute that to?
Sure. It starts with the thesis of the Richard Branson quote: "If you take care of your employees, they'll take care of your customers," or in this case, we call them clients, and then the clients take care of your shareholders, right? And that's kind of what we've built here. So the first thing that that creates that is the fact that our agents really are loyal to IBEX, and that creates our ability to deliver consistently, month over month, week over week, day over day for our clients, and not be up and down on quality. So consistently outperforming the others, driven by those agents and that tech stack. And that's kind of what we've built. And look, if you look at our employee net promoter in every geography that we operate in, it's off the charts. So we have the confidence that we can go into every region that we operate and take that model and out execute. And that's what we've done. That's what we've built. And so it's repeatable. That's probably the most important thing. And that's why we're, really feel confident in the trajectory of this business.
Okay, thank you. And a question from the audience. Can you share thoughts on how much of your growth has come from clients outsourcing new assignments versus market share gains from competitors?
Yeah, we do measure that. Okay. And it's interesting. So when we win a new logo, okay, in its first year of revenue, we're ramping. So we're starting, we're scaling, we're ramping. And usually in that first year, we'll we'll do an expand based on doing a really good job out of the gates. We'll expand with a new line of business, a new geography. And so it's really interesting. If you look at the trajectory of a new logo, the revenue we get out of the new logo in year one will be about 2.5 times that in year two. And we have a long track record of seeing this. And then in year three, it'll grow another 50%. And so, kind of, we look very carefully at the cohorts of the new business that we bring in. Now, in year, those new logos, because they're ramping, they have a smaller impact in the first year. But as they scale in year two, they move the needle. And so, so we kind of look and say year one, those new logos will probably have, if we're growing at 15%, they'll have a small percentage of that. It might be 2 to 3%, but that new logo will have a big impact in year two, And so look, I'll give you, and I shared this in our earnings call last. Our top 10 clients, we grew at 20% this past quarter from prior year. So, we're getting strong growth there, and then we're getting, the right new logos that can then scale significantly, in those year 2 and 3, and that creates this flywheel. Thanks for that question.
Okay, thank you. Another question here. What are the key catalysts for clients to outsource assignments?
I'm sorry, Anya, could you repeat that again? Sorry.
Yeah, what are the key catalysts for a client to outsource assignments to you rather than have it in-house? What value proposition do you have?
Yeah, sure. Great question. So I'll give you an example. One of the, most clients that we've seen, Fortune 100s that are outsourcing a bunch, a sizable amount of their work, and they'll probably have some captives themselves. But we actually had one of the very, very large home improvement companies had all of their work in captives. And so their first move they were looking at, because of the cost challenges that they have, and they realize that they're paying, $85,000 to $100,000 a year for an agent sitting in, in North Carolina. And, as margins are getting challenged, compressed, everybody's looking at all areas of the organization. So they looked at us, they looked at the industry and said, hey, we want to outsource first time. And we brought to them a solution in a nearshore environment where it could be done at a fraction, probably at about a 60% savings of what their captive onshore operation were. But now they didn't make the decision on price. They made the decision on, in that market, who could actually provide the best solution. And when we brought in our story of our culture, and this we launched in Jamaica, and then we quickly expanded into Nicaragua with them, and now we have about 80% of their, and so they only have about 20% left in the captive, and the 80% is outsourced to that. That's been kind of a 2-year journey, but it's, they look at big cost gains, but they wanted to make sure that when they moved into the region, that it wasn't something that was going to deteriorate their customer relationships. And actually, the reason they've gone from 0 to 80% with us is because we're outperforming what their captive operations are. And so, it's the old commercial, it's quality and cost a lot of times is the play that's the solution that we solve for them.
Okay, thank you. And another question here. Do you anticipate AI to be a greater demand driver going forward, and how might that play out for you?
Boy, that's a great question. So AI, we see AI as a significant opportunity for us to take. And what we've done, I'll just share with you, we've partnered with a couple of the best AI companies in the world that are creating AI agents. But the value that we're able to bring is we take our business insights organization that for all of our clients, we understand customer journeys, we understand as a result of that, what is appropriate to use AI to automate and what isn't. And we think leveraging this powerful engine with what we have, you create the Ferrari of AI. And that's how our clients are viewing us as, kind of able to take that and build that great solution, leveraging our capabilities. Now, what's exciting about that is that when we bring that solution, the margin in that offer is significantly higher than the margins that we have in our current business. And, kind of our margins, in our current business operate about 30%, 30, 31, kind of bounces around a little bit. But when we look at that AI solution, that's more than double that. And so we think that that's going to be a high growth vector for us. And then again, another growth vector that's going to be a significant margin expansion. So we're really excited about our position as being well ahead of our competitors in delivering that solution. And then by winning, we were excited about, having, a growth vector be a very, very strong margin expansion vector. Thanks for the question.
I think we're kind of out of time, but we have two good questions here I'm going to squeeze in. One is kind of a follow-up to the one we just touched on. What percentage of your total customer interactions are currently handled end-to-end by AI with zero human intervention? And what's the fully loaded cost per resolution compared to human agent?
Boy, that's a great question. So look, we are early in the journey on the AI. So, so we're kind of on this high growth, but it's started from zero. So, so it's still small, right? And not material. So we believe that that's all future upside. Okay. That's in today's results, it's really not moving the needle yet. That's what we're excited about, is those are futures. Okay. Now, high level, I look at it and say, if an interaction is serviced in the US, it's between $8 and $10 an interaction. If it's in a market like the Philippines, it's probably $3 an interaction. And when you look at AI, it's probably about $1.50 an interaction. Just to give them kind of just ballpark, and each client's going to be different, but that just kind of gives you the scale and magnitude of that. So it's really compelling, if you can do it effectively. Interestingly enough, is most early solutions that have been built by tech-only companies, et cetera, have not really been successful. And so, MIT did a study that said 90% of them have not been effective at all. And so what we're building is that solution that doesn't lead with your chin, that, really says, these solutions you should automate, because we as consumers would like those to be answered quickly, fast, not have us be on hold, all of that stuff. And so, we're kind of excited about, about all of that and our ability to really solve what's needed, which is the right amount of automation for the right interactions and do that successfully. With that, Anya, I think we'll probably come to the end of the time, but thank you guys all. Love the questions. They were spot on, and hopefully, look, we are really confident in our journey. We've done this over a long term, and it keeps getting stronger. So, we love that, what we built here. And thanks for your time.
Thank you so much, Bob and Taylor. And yeah, it looks like you have a very, very strong story here. And I know you have a strong one-on-one schedule as well here, but if anyone in the audience would like to catch up with the management and learn more about the company, you can reach out to us at Sidoti or the company directly, and I'm sure they will make themselves available. And with that, I'll hope you all have a good rest of your day. Thank you.
You
Thanks
as well. Thanks for your time.